Over to you, Mayank.
Thank you, Crystal, and Happy New Year, everybody. Just to give you a bit of a perspective on the energy markets first, before I go into the impact of what you are thinking about from a Venezuela perspective on the energy markets. I think this year we are starting off with a reasonably well-supplied oil market. We are expecting first half specifically in the oil markets to see reasonable non-OPEC as well as OPEC supply to come through. And that basically keeps the glut in oil markets to be at least there till the first half of this year. Our overall views have basically been that we will see closer to $55 to $57 in terms of Brent oil prices for the first half of this year. And then it starts to kind of gradually go up for the second half of the year. Now, in that context, Venezuelan supply, first to give you a perspective of what Venezuelan oil markets kind of were, where they were in the history and where we think they kind of get to. Venezuela supplies close to around 1 million barrels per day of oil in terms of exports to the world. Okay, that's about almost a percentage point of the total supply of oil. In the past, it was around 10 odd years back, when the sanctions were less, you had seen close to around 3.5 million barrels per day, which is about 3x of where it is kind of producing last year. And in the last few months, you have seen, because of sanctions, the production go down, or at least exports go down by 0.2 million barrels per day. So our view is that at least that 0.2 million barrels per day kind of comes into the market, and then at least 0.3 to 0.4 million barrels per day where there is infrastructure available, that can actually kind of come through over the next 12 to 18 months. Some of the consultants believe that number could be even higher, but overall, at the margin, we could kind of see at least 0.6 million barrels per day incremental supply from Venezuela from a 12 to 18 month perspective is the way we are thinking through this. Now, Venezuelan oil, the quality of the oil is reasonably heavy oils. It's not that easy to process in a fuel refinery. So there are specific complex refiners in the world which can kind of use Venezuelan oil to mix and match and kind of process it. One obviously is the US Gulf Coast refiners who can do that. But from an Asia perspective, the Indian refiners, a couple of the Korean refiners and China refiners can actually process that kind of oil. Historically, from an India perspective specifically, we have seen in 2015, 12% of India's imports of oil used to be from Venezuela. That number came down to less than 2% as of 2025. Specifically, the biggest player in the market for importing Venezuelan crude in India used to be Reliance. It used to get around 25 to 30% of its crude requirements from Venezuela. Now, Venezuelan crude, the interesting part is it kind of gets a bigger discount to the benchmark crude prices of up to $20. So technically, that adds 5 to 6% straight away to earnings for refiners as such, because of the discount that comes into the crude price. Also, because there is an element that they also produce higher amounts of what we call as diesel, where the markets are extremely tight. So fuel markets globally today are very, very tight. And that's where I think some of these refiners also kind of get a tailwind as well as they process more Venezuelan crude. So Reliance in India, as well as some of the other complex refiners in India, actually benefit quite a bit from this. And India has been one of the few countries around the world which have actually upgraded its infrastructure on fuel refining over the past 6 to 7 years, when most other people were worried about oil demand. And that's where I think some of the other names like Indian Oil and Hindustan Petroleum kind of stack up very well apart from Reliance in the overall picture. So let me just stop there and pass it back to Crystal.
Thanks very much, Mayank. Before we take any questions, let me shift to Korea for now. Korea had a strong start, and then June also raised his 3 to 6 month Kospi band. And then shall we pass to June to share his thoughts on markets and sector preferences? And then also after June, Korean won also rebounded sharply late December. We have Kathleen as well online, and then maybe after June, I will let her share the policy outlook.
Yes, thank you, Crystal. Yeah, so Kospi's had a really good run at the start of the year, and last year we ended at around 4,200. We're already up beyond like 4,500 at around 46 now. So it's really been kind of driven by last year's winners again, and obviously I think the kind of the strengthening of the won has also helped out, which I think Kathleen will talk about more. But I think overall, investors are still quite positive on Korea. So just before going to the corporate reform, I mean, if you look at tech, which has really driven the market this year, Sean has been very positive on the story. So if you look at the chips on the DRAM NAND side, prices have gone up, for DRAM around by about 4 times in the past couple of months, and HBM prices are also quite resilient here. And when the equilibrium is going to be reached is really kind of anyone's guess. And with a shortage of kind of chips everywhere, we do think that our earnings the growth will still be strong. Today we did see the prelim numbers come out, but overall I think when you look at the chip sector, we are still kind of positive on that, and also the AI investments are continuing to take place. But we have been a bit more maybe also focused on the peripheral tech. So on the MLCC side, you have Semco, and then you have the smaller tech names such as Isopetisis and Hami Semi. So moving away from tech, the other sector that we've liked is in industrials, and today we are seeing quite a good move for the defense stocks. And if you look in the past week or so, we've seen Rheinmetall and the Korean defense stocks go up quite a lot, more than 15%. And it was kind of interesting, I think, until like yesterday, where there was a bit of a change in the leadership. It was kind of led by Korea Aerospace and LIG Next One. With what's kind of happened in Venezuela, it seemed to have accentuate the need for the importance of air defense systems and also an air force. So kind of reason I think why they kind of outperformed. We still like the defense sector from here. Hana Aeros has been a top pick and is also in the focus list, and there's kind of more to go. The other sector we've liked is also autos. We upgraded that late last year. Robotics has also kind of, I think, been a thematic that's been linked to the Hyundai Motors Group. But overall, we do think that the auto industry, which sector would have been in the doldrums for a while, if we see Fed rate cuts and also consumption holding up in the U.S., we do think that the autos is another kind of positive story. So we've actually raised our trading band for a Kospi to 4,100 to 4,800 for the next 3 to 6 month period. Previously, we were at 38 to 4,500, so raising it kind of closer to where our bull case is, which is 5,000. To reach kind of 5,000 and get beyond that, we do think there needs to be a cyclical pickup and also reforms to really start kicking in. So let me just kind of move towards focus more on the reform side now. We've seen a lot kind of take place last year with the commercial code changes and also the dividend tax regime change. This year, I think we believe the focus is going to be more on the domestic liquidity side. And the other focus was going to be also the Capital Markets Act revisions, which is kind of complementary to the commercial code changes. And for the Treasury share mandatory cancellation, which has been a bit delayed, we do expect that in January that it will be passed. So on the key kind of domestic liquidity elements, I think the quick questions that we are being asked is, will the retail investors look to invest in dividend stocks? We do think this is a viable story, and we do expect affluent retail investors to be interested on the dividend angle, but the flows may not be enough to really impact on index level, but certainly on a stock or a sector level. The second is going to be, will the reshoring investment accounts and the other types of retail kind of investment options coming out, would that lead to more local participation? Well, we are already seeing, I think, money moving out from kind of bank deposits into the capital market space. And in terms of whether money will come back from the overseas market, we'll have to see. But I think we can probably see maybe a little less money maybe moving out and maybe a bit more money kind of moving into the local markets. So, but there is a bit of a stickiness, I think, to the money that's left Korea. But overall, I think retail investors, with the options that they have, there should be a bit more interest, I think, maybe on the growth side, growth stocks initially, but also on value. And lastly, on the pension fund side, we do think that there could be changes to the corporate pension program right now, which is around 430 trillion won. We don't really have details, but I think that will be a swing factor. And also, we'll have to see whether there's changes to the national pension sector allocation. Right now, we're at 14.9% for stocks, for domestic equities, but we'll have to see how that kind of plays out going forward. So quickly, just how to play the reform. We do like the financials here, and we have been a lot more kind of focused on the securities business, but we also do like the laggard banks. Dividend stocks are still in play, especially ones that are, kind of at 25% or slightly lower on payout. And lastly, for the governance and the corporate kind of sector, I think we need to look at it more on a group level than just the holdcos. Let me stop here.
Thank you very much, June. And then just very quickly before you log off, in terms of the feedback from foreign investor, do you think that they're actually looking to rotate among the sectors? Because so far this year, it still has been the semis leading the rally in Korea.
Right, because it's been such a strong rally. I'm not. It's really difficult to see whether everyone's kind of been participating in that in time. But I think generally our kind of take is that there's still positive sentiments towards the chip makers. And if you're going to and for the rotation side, I think the rotation from to the value side will take maybe a bit more time. And also we have elections coming up. And when you look at election periods and heading into it, we have seen some of the domestic related stocks like banks, the staple side, also get into a bit of a more of a volatile situation. And so I think for now, tech and industrials are still kind of the spaces that foreign investors are still kind of focused on.
Great, that's super clear. Thank you so much, June, for your time today. And then next, let me pass it to Kathleen to talk about the policy outlook following the rebound in Korea won.
Great, thank you, Crystal. Hi, everyone. Happy New Year. So the Korean won has been the center of attention since the end year 2025, with the strongest rebound we've seen in the past 2.5 weeks or so before we see some weakening trend in the past 2-3 days. But still, compared to the more than 8% weakness we've seen in the currency during the second half of the year, we did see it rebound very quickly to 2.5 to 3% during the last 2 weeks of December. And coming into this week, we also see it staying around 1450 level. A bit of weakening there, but still compared to last year's level, we do see it a lot more stable than what we are used to during 2025. A couple important policies to highlight on this front. Even just going back to November, we did hear the verbal comments and concerns coming out of the local authorities multiple times, but no followed action was there. But in December, we had 3 meaningful FX measures came out of the Ministry of Finance and the BOK. The first one, 15th of December, was the BOK MPS swap line extension, which was relatively very much expected, and the impact on the market was rather limited. And the second measure came in on the 19th of December, where we've seen the bank's liquidity, the measures, incentives for the increase in the U.S. dollar reserve for the local banks was offered, but that one also again with the minimal impact on the markets. But what we did see rather a significant move from was the 24th of December, when the local authorities started the morning with the aggressive language where they addressed the excessive weakness in the dollar won. Usually they would stick to more neutral language around they were not comfortable with the skewness in the FX or volatility on the move. But they specifically mentioned that they were not comfortable with the excessive weakness of the won, and hence they came in with with the FX measures that afternoon, the tax revisions and also incentive measures for the retails and the corporate for a potential dollar repatriation moves that they said will start from 1st of January this year. And on that, we did see dollar won moving quite notably. It did track back about 2.5% on the day, and until last week, we've seen it gain to around 3%. But however, I think the real test really started this week when everyone came back, and also the liquidity and the market activities came back to normal. And we did start the week with the Venezuela new headline, which the geopolitical risks had led to a bit of a strengthening of the dollar, and also at the same time, the early year dollar demand from local players also had led to a bit of the performance on the currency. But fundamentally, what we're looking for is that going forward, we are looking for a strong rebound on the economy in the first half of this year before we see it maybe stabilize a little bit downward in the second half. But the fact that we do see the fundamentals improving, as Governor Rhee from the BOK recently has mentioned, the recent weakness in the won does not represent or does not, it seems misaligned with the domestic economic fundamentals, which we do agree. And our FX team and our strategist GEC stays constructive on the currency because of that fundamental picture, as well as the recent strong measures that just came through that I mentioned. We do, at the end, do expect further measures to come through, though. I mean, first, on the retail side of the tax revisions, we do think that could drive some marginal repatriation. But the fact that they have kept the size of the repatriation size that would be tax exempted to around 50 million Korean won, that's equivalent to just around maybe 35,000 US, we think is rather low. And I don't think many retail investors would be per se incentivized to repatriate that much to get the tax exemption. And further, we do think the US equity market outlook staying rather buoyed would have less incentives to repatriate for the local retail players. Hence, we do think there could be further incentivizing measures going forward. On the corporate side, though, we do think that the repatriation by the corporate could show some meaningful flows back, as we've seen the case back in 2023, where the repatriation came to around 33 billion by the local automakers from the US, high earnings, and also the cash reserves for the local players actually going down, while the repatriation flow going up. So compared to that period at this time, we do think the size of the actual conversion may remain questionable, but the actual flow coming back to Korea could be incentivized with these tax measures, as we've seen in the case in 23 again. I mean, just lastly, though, we do think to maintain this sustained momentum in the dollar won strength, we need to see more structural changes at the fundamental level, which we expect it to be the MPS's new framework announcement. They are looking, or the investment committee should be looking into the new changes in terms of the mandate allocation, or even the hedging ratios that would be on the table. And although the details for now is a bit sensitive to mention, and still the visibility is rather low, but after the new CIO is appointed, which we think will be in the next few weeks, it's likely that their investment committee meeting, which usually is held May every year, could have a slightly earlier schedule because of this planned or anticipated announcement on the MPS's new framework, which we then do think would be another rather meaningful driver for the dollar won to stabilize further. And hence, again, we remain constructive on the dollar won and expect the domestic economic fundamentals to support that. I'll stop here.
Thank you, Kathleen. And then I see we have Daniel on the line, and then just checking whether Daniel is audible.
Yes, thanks, Crystal. So wanted to share some feedback on the trip feedback on a trip to DC last year, just at the end of December, leading into obviously a pretty pretty volatile start to geopolitics in 2026. Overall, the tone was actually a bit more constructive on US-China relations. We had seen the licensing of H200s and indications of interest coming through for those chips. But more broadly, the diplomatic calendar setting up for four key meetings over the course of the year. Excuse me. That include a expected bilateral meeting of Trump and Xi in Beijing in April, as well as the hosting by the US and China of G20 and APEC towards the end of the year, as well as midterms, are all leading towards this sense of optimism on the US-China relationship. But it's not without its sense of volatility and frictions, as we see. So a number of flashpoints we need to keep an eye on. But overall, we do think this relative point of stability in international relations is something that investors are hanging on to. Overall, in terms of the outlook going into the year, we have kicked off with very strong momentum in the earnings expectations for Taiwan and Korea, where we're looking for solid positive revisions and earnings growth expectations. So that momentum kicking off is important, but we're also in this environment of seeing, I think, prospects of improved valuation dynamics for key parts of the LATAM space. So as we're looking at the elections coming up over the course of the year, it's going to be a lot of focus on not just Korea in our part of the world, but also in Thailand in the short run, but looking at Brazil towards the end of the year as another key catalyst. So overall, pretty constructive start to the year. US-China relations have got a number of friction points, but ultimately setting off with a more constructive tone. So with that, I'll pass back to you, Crystal.
Thank you so much, Daniel, for dialing on the roll. And then last but not least, we have Praveen on the line as well. And then now we're shifting to talk about the Hong Kong property. Praveen holds a contrarian bullish view on the cycle. And then can I invite you to share the sector views and also your topics?
Hey, Crystal. Good morning, and thank you very much. Excited to join the Thursday Macros webcast for the first time. I want to highlight our recent call on Hong Kong real estate, and we are calling for property super cycle. People think we're crazy, but we think 2026 will be the first year to have, when we have all three subsegments, office, retail, and residential, to report a positive growth. Residential price will be up, central office rental will be up, and the Hong Kong overall retail sales will be up. Remember, in the first half of last year, in 2025, all three numbers were negative, and it has been the case for the last 5-6 years. So our preference is residential over office over retail. We are calling for double-digit growth in residential. So it's not just we are positive, we are very positive. Well, the usual stuff of low supply, high demand, affordability back to 2011 level, rental yield in Hong Kong being better than China, the rental yield being higher than mortgage rate, meaning positive carry, and the fact that US rate will be expected to be, the rate will be cut in 2026 are well understood by market. What I think is not very well understood, or at least appreciated, is the removal of the complete stamp duty, which in Singapore case is 64%. It used to be 30% in Hong Kong. Now you don't have to pay anything to buy, nothing to sell within 3 years, 2 years, 1 year, 6 months. You can buy 3 apartments, 5 apartments. And what we're seeing is that we're seeing a lot of units which is selling at a very high price. We're seeing a lot of people buying multiple units. We're seeing a lot of people buying and selling very quickly within 6 months. Yes, some of these things are speculative, but we think that's needed in an upcycle. So enjoy this upcycle. We want to buy Sanankai, Henderson, and Cheung Kong asset. Henderson could cut its dividends, so we will stick with Sanankai and Cheung Kong asset. On the short side, we have New World, Wharf, and Wharf REIT as underweight. We don't like retail because in the last 3 months, the online sales have gone through the roof. The online sales in Hong Kong, which never picked up, is up 27% for the last 3 months every month. This is driven by PDDs of the world and Kitas of the world and Meituans of the world coming to Hong Kong and hurting the sentiment as well as the retail sales for the malls. And so you want to avoid malls, and that's why we downgraded Link REIT with this report. So Sanankai, Henderson, Cheung Kong, long on the short side, Link and Wharf REIT would work. I'll stop here and hand it back to Crystal.
Thank you so much, Praveen. And then now we are moving on to the Q&A session. We have a question for Mayan. So Mayan, can I ask you, the client is asking whether Venezuela impact Asia refiners, or is it more of a US impact? And then also, how does it tie with your Thai fuel market view? And then also, can Venezuela supply more fuel products?
Okay, yeah, that's an interesting question. I think so. Let me put a bit of a perspective around where we are on the global fuel markets. Correct. Over the last 3 years, it has been an extremely tight market to kind of get gasoline, diesel, etc. from anywhere in the world, because new refining capacity for fuel has really not shown up in any major way, and global consumption for fuel has gone through the roof. Right, we are running at peak demand for fuel products over in the last 3 to 4 years. And the growth rates has consistently surprised on the upside, especially for transport fuels. And our view is that for the next 3 to 4 years, we do not really see any new major fuel refining capacity coming through in any part of the world. Even China exports have been largely muted. So if you put that in perspective of what's happening in Venezuela, see, there are in Venezuelan crude, as I was talking about it earlier, it's a very thick crude to process because it doesn't really flow that well. And because of that, not all refineries can process it. You need to have spatial infrastructure to kind of process it. And that's where I think the Asian refiners, like in India, some of the Chinese refiners, as well as some of the refiners in Korea, do have that capability to kind of process that crude. And those are the refiners which get the tailwind from both the cycle as well as the impact of cheaper Venezuelan crude, because the discounts on these crudes are pretty material. Correct. In 2012 to 15, when Venezuelan crude was a bigger part of the market, you had seen upside risk in earnings if that was to flow through even this year, close to around 8 to 15% just for the Indian refiners, to give you some perspective of what we are talking about in numbers. And finally, I think in terms of the Venezuelan exports of fuel, we have not really seen too much new infrastructure on Venezuelan refineries at all built up in the last decade. So really, that's less of a risk from our perspective. Crystal, back to you.
Thanks very much, Mayan. And then we have several questions for Praveen on the line as well. Praveen, do you think after a 30% surge in 2025, what can drive further upside for Hong Kong property for this year? This is the first one.
Yeah, so that's a good question. The stocks have run up, obviously, because that's how it works when your cycle turns in June 2025. But remember, these stocks were trading at 70% discount to NAV. Now they're trading at 50% discount to NAV. The transactions that we're seeing in the market is allowing us to believe that NAV is very solid. And so we expect that the discount to NAV can easily narrow at least till 30%, if not to 20%. This movement from minus 50 to minus 30 or minus 20 means that the stock could go another 30, 40%.
Thank you, Praveen. And then the next set of questions are, what's your view on should people buy property in Hong Kong right now? And then because currently we see some de-recovery for mass residential projects and also the luxury market as well. And then do you think that developers are able to raise prices for the new project launch in 2026 and therefore further boost their margins?
Yeah, so two different questions, one for consumer like us and another for developers. First on developers, the margin for this year as well as in 2026 will be pretty bad because you're recognizing the projects which was sold in the last 2-3 years, which has been terrible because prices have been coming down 30% from the peak. And so the future margin for projects are improving, which is exactly going to be visible in 27, 28. I think market can see through it, but you have to be very careful about that, looking at the margin very carefully about each of the projects, each of the companies. What we have seen in one of the projects in Kai Tak, in Sanang Kai, their phase 1 was selling at a certain price and phase 2 went up by 30%, 30. So absolutely ASP is going up slowly and steadily, but in some cases very, very quickly and at a very big margin, and margin will improve in 27, 28. The question about whether we should all buy property or not, it's a question that can be answered in two segments. very high-end people or rich people or high-end people who are living in a rented apartment because the rental yield is very low, and the high-end, the prices tend to be significantly higher. You should stay rented. There's no point trying to buy it because you'll never be able to get positive carry. But in the mid-end, I think people should definitely buy because the rental is going up. We're thinking about rental being up 15 to 20%. You don't have a choice. You'll be priced out on rental, and the mortgage rate is dropping. So for mid-end, which is where the belly of the entire demand is, I would recommend buying, if not necessarily 2-3 units, but if you don't have any unit, you should have 1 unit.
Thank you very much, Praveen, and then thank you for your time as well. So in the interest of time today, we will conclude the webcast here and then also answer the remaining questions offline. Thank you so much for joining us again, and do reach out to me and the team if you have any other questions. Have a nice day and see you next week.